You were, of course, at the IMF as well, weren't you, Alicia? Now, the thing is about this whole debate, whether we raise rates and when we should, is because they've been unnaturally at zero for so long that there's almost now a case where they need to do something to normalize. And that's the one side of the argument. Then there's the other side which says, well, if you're going to be data dependent, there's not a single shred of evidence out there, because inflation is the central remit, that they should be doing anything.
That's right. I mean, and Jose Viñals, by the way, who used to be my boss at the Bank of Spain, so I can't even fancy contradicting such a, wonderful economist. But frankly, I think we're really stuck with this. I mean, yes, the data doesn't look fine, but if you look at projections for U.S. growth, they're actually about potential. We were talking about 3% growth. So maybe what is happening is that there are structural changes in the U.S. economy, to my mind, actually everywhere.
Structural changes along the whole, the developed markets, I suppose. Of
course. Yeah. I mean, the labor markets don't work as they used to. We're not creating the jobs that we wanted to. And I think we're maybe focusing on stuff that will never come back. So what to do with this huge liquidity out there? I mean, of course, investors are quite happy with the decision. Yeah? I mean, we keep on having the search for yield. We keep on having liquidity going into non-liquid assets. Who's going to reverse all of this, if you think about it? I mean, we have a chapter in the IMF Global Financial Stability Report talking about liquidity mismatches and, what may happen if the Fed starts hiking rates in as far as a lot of the investments are now in non-liquid assets. So even if liquidity is ample, there could be actually events in certain bond markets, in, of course, distress that, imagine, where we could have systemic risk. So I think we're kind of stuck there, and the fun is kind of realizing that it won't be as easy as we thought.
But that's it. And you mentioned non-liquid assets, and by that very nature, that's where we've seen some of these asset bubbles, haven't we? And, even modest rate hikes can actually cause those bubbles to burst.
Exactly. So I think we're now in a world where nobody ever would imagine the Fed going, as it used to. So we're all thinking about very minor hikes. That's fine. And some are even thinking no hikes. Why? Exactly because of the reason you mentioned. Because we are at a time where even the minor change in liquidity may have a very, very big impact on some of the markets.
But there's this urge, okay, well, because it's been like this for so long, we need to do something. We need to go back to the old days, is what you're suggesting. Yeah?
Well, put it this way, we could also rephrase the whole thing by starting with, kind of Bretton Woods type world where we all discuss what are the targets for central banks. Their targets are, maintaining decent level of growth, and more so, especially for the European Central Bank, only so, maintaining a decent level of inflation.
To go back to the gold standard.
Yes, the point is, if they're supposed to care more about financial stability, which is, I think, where we are heading, if you think about how the Fed is behaving, then maybe that's the way to go. But at the end of the day, we have massive balance sheets out there for central banks, and the minute they keep on growing, which is basically what's happening, and Fed is not growing, but it's at a huge level. The PBOC is growing. The European Central Bank will grow. BOG will continue to grow. So where are we? I mean, is this a place where we can actually stay forever? That is really the question at this point in time.
And the answer?
I think we can't, unfortunately. And the reason why we can't is that there's no limit to how addicted markets can be to liquidity, meaning that very limited amount of liquidity that you may need to withdraw will make it to create a problem somewhere. So in a way, you have to come back and forget about the inflation target. You have to come very slowly to smaller balance sheets from the central banks to let markets actually play out, by exchanging liquidity among themselves, not really relying on this. So the answer for me is, yes, we need to reduce the balance sheets, but the question is, do it slowly.
Yeah.
You better do it slowly.
Tell me something, what has been the transmission mechanism of these growing balance sheets onto the real economy? That's the thing.
Good question. Well, there are very different pictures out there. Say Europe, where, we know, the mantra is that nothing has actually happened. Actually, if you look at credit numbers in Europe, even household credit is starting to move pretty I wouldn't say
But the hope is
aggressively.
that banks start lending. That's
Yes,
the thing, isn't it? Yeah.
banks are starting lending. So if I think, in a way, frankly speaking, and ironically, the ECB is in a better position because they've done less. They actually had to reduce the balance sheet because of bringing back the LTROs, as you know, and that actually puts them in a position where the balance sheet is actually half what the Fed is. And they have already instilled this credit in the economy. So, maybe they are the ones to finally exit in first.
Alicia, very quickly, in 10 seconds, 2016, what's it going to be like?
I think it won't be as bad as people think. EM, I think people are very, very negative. If there's a pause with the Fed and China, which we are already seeing, that's some fiscal, which they are doing. I mean, it's just that they can't announce it, out and loud. I think 2016 won't be a horrible year. I don't think it will.